Hi everybody, it's a lovely Saturday morning here in my world, and I'm at the office working on getting your class ready. So as I was looking forward to chapter 18 where we start talking about revenue recognition, I realized that one of the things I want to be able to spend some time with you on is how to account for sales with the right of return. We're going to spend a lot of time in chapter 18 talking about some exceptions to the standard rule, but this is not one that we'll really get much opportunity to talk about, and it's really pretty important. There are a lot of folks who struggle with this in the real world, so I want you to have a chance to take a look at it. You're going to need your book. Chapter 18, exercise number 6 is what we're going to work for this particular mini lecture. All right, so here we go. The guidelines to your basic revenue recognition rule is very straightforward, and it is something that you're going to need to know forever. And that is that you recognize revenue first when it is realized or realizable, meaning you've either received the cash, meaning it's realized, or you have a high confidence that you're going to receive the cash. And 2, when it is earned, or when the earnings process is complete. In other words, if you are the seller, you have done absolutely everything that you need to have done in order to be able to claim the revenue. So if it's a product, you've placed that product and the title to that product in someone's hands. If it's to the buyer's hands. If it's a service, you have actually provided the service. Now, for the most part, when we talk about revenue recognition, we're going to talk about recognizing revenue at the point of sale, meaning when it is realized, realizable, and earned. The thing is, in this chapter, there are a number of exceptions to that rule, and we will spend a lot of time on the exceptions. For example, the first exception is there are occasions during which you can recognize revenue before the earnings process is complete. There are also cases where you will delay recognition after the earnings process is complete because you have a high degree of uncertainty to deal with. In particular, we'll be talking about long-term construction contracts and installment sales in each of those 2 areas, and that's where we'll spend our time in class. There are, however, some issues related to typical run-of-the-mill sales where you have a high likelihood of return. For example, if you think about, and I think the exercise we're going to work has to do with sales to a college bookstore, where you don't really know how many of those books are going to go off the shelves and not come back. All right? And so let's talk first about the methods of revenue recognition that are available to you. They're all okay. They're reasonable methods of revenue recognition. First one is, if you have a sale where there's a high likelihood that it could be returned, you could just postpone the sale. Don't recognize it until the time during which it could be returned has expired. So if I've made a sale and it's got a 30-day return policy on it, I could just wait 30 days to recognize revenue. Most companies don't really want to do that, but it is a legitimate way to deal with that risk of the product coming back. The second thing you could do, which is pretty common, is you could say, well, I've got a history, and for product X, when I sell it, approximately 10% of it gets returned during the 30-day return period. So what I could do is when I sell product X, I could go ahead and recognize 90% of the revenue. Okay, fair enough. The other thing that we could do is say, no, I'm going to recognize 100% of the revenue, and as the returns roll in, I'll start recognizing them at that time. The problem with the final approach is that if you have a high rate of return and you know that those returns are going to be coming in, you can use that to kind of manipulate the financial statements and make your sales look better than you know they're going to be. All right? So those are the ways, though, that you can handle a sale with a right of return. But because there's a lot of manipulation of revenue journal entries in the U.S., there are some conditions that the FASB has set forward for recognizing revenue under any of those models for sales with a heavy right of return. They have to meet 6 conditions, and you can take a look at 3 of them are here, 3 of them on the next slide. First, in order to be able to recognize revenue on those sales with a right of return, in other words, not to have to wait until the return period has expired, First, you've got to have a substantially fixed or determinable sales price. The buyer has to pay. Second, has to pay the buyer has to pay the seller, or they're obligated to pay the seller, and it's not contingent on reselling the product. So it's not that the buyer says, "Yeah, I'll take that, but if I can't resell it, I'm bringing it back." Third, the buyer's obligation to the seller doesn't change in the event of theft or physical destruction or damage. What that's really saying is that title has transferred to the buyer, and so if they buy the product, even with a high right of return, but they buy the product, they put it in their warehouse catches on fire, that does not become the seller's problem. I should say fourth, fifth, and sixth. Sorry, those are numbered incorrectly. The buyer acquiring the product for resale has economic substance apart from the seller. In other words, they're not related parties. The seller doesn't have any significant obligations for future performance, so they don't have to come. If the buyer purchases the product and is having trouble selling it, the seller doesn't have to take responsibility and say, "Oh, I'll move that for you." It's not their problem. And finally, the seller has to be able to reasonably estimate the amount of the future returns. That usually takes a little bit of history for them to be able to do that. And sometimes it's a matter of saying there's a maximum percentage of the sale that can be returned. Okay? All right, so in order to be able to go ahead and recognize revenue, whether it's recognizing the revenue gross and estimating the returns, or it's recognizing it gross and waiting until you have those returns to account for them, the seller has to meet these 6 conditions. Okay? Otherwise, the rule is going to be you just hold on till the return period expires and then you can recognize revenue. Okay, so what I'd like you to do is take a look at exercise 6 in your book. The facts are reprinted here for you on the screen. You've got a publishing company that publishes college textbooks that are sold to bookstores with the following terms. Each title has a fixed price. That's important for our 6 criteria. The terms are FOB shipping point, which means title transfers to the buyer at the point of shipping. Payment is due 60 days after the shipment. The retailer can return a maximum of 30% of an order at the retailer's expense, so it's their cost to get the books back to Udden Publishing Company. Sales are only made to retailers who have good credit ratings. Past experience indicates that the normal return rate is 12% and the average collection period is 72 days. So if you think back to the 6 criteria, those 6 criteria, given this information, seem to be met. Absent any additional information, we're going to assume that this is a place where a seller has an option about how to record his sales with a right of return. All right. So question A asks, well, would you identify the alternative revenue recognition criteria that Udden could employ concerning their textbook sales? All right, so your options are as follows. 1, they could recognize their revenue at the point of sale based upon the time of the shipment, because the books are sold FOB shipping points. So the moment the books are sold, they can go ahead and recognize revenue. And what we're really saying here is they can record the gross sale at that time and simply account for returns as they occur. The second option that they have is to wait until cash is collected based on their return policy. So they could wait until the end of the time period, the return period, in order to recognize all of the revenue that would then be available to them. And finally, they could go ahead and recognize revenue less the estimated returns at the shipping point, because they can estimate the returns. They have a history that indicates about 12% of their books come back to them. This is again kind of saying record the sale at its estimated net price. All right, so question B asks, or if those are your options, what do you think you're going to choose? I would say that your best option here is to go ahead and recognize revenue minus the 12% normal return factor at the shipping date. And here's why I think that's the best answer. There's no evidence that any of the gap criteria were not met, so I think the sale meets the criteria. Legally, title is transferring to these books at the shipping point. You've got a history. You can estimate the number of returns or the percentage of returns, so it makes sense. Now, I suggest using the 12% normal return factor. If you really wanted to be conservative here, you could instead say, well, they could return up to 30% of the purchases. That's the maximum return allowance, rather than the 12%. That's a hard sale for me, but it is a legitimate choice. I mean, if you really want to argue conservatism, you could say this is something that they should do. All right, question C. In late July, they ask you to assume that the publisher shipped the books invoiced at $15 million. And they ask you to prepare the journal entry to record the event based on your answers to Part B. In other words, we're going to do this. We're going to record these journal entries using a net estimated sale approach. All right, so the first thing we're going to do is we're going to debit accounts receivable and credit sales for $15 million, because that's how much we've sold. Concurrently with that, though, we are going to debit sales returns and allowances for $1.8 million. That's the 12% that we think will come back to us. And we're going to credit the allowance for sales returns and allowances for $1.8 million. Notice the asterisk here. You could, and some companies do, just debit that directly to sales revenue. I'm not a fan of that, because I think when you decrease sales revenue directly, it becomes a little harder to track how much of your inventory actually, or sorry, how much of your sales actually did come back to you. I think if you keep it in a separate account, it's very easy to see and calculate what your percentage of actual returns were. But either way, it would be fine. All right. So this is what Udden Publishing Company should do in July when they make these sales. Question D asks you, in October, assume that $2 million of the invoiced July sales were returned according to the return policy, and the remaining $13 million was paid. You're asked to prepare the journal entries. Okay. All right, so we estimated that we would get back, that we would, we set up an allowance for $1.8 million. And we missed a little, but that's the one thing you know with certainty about an estimate, is that it's not going to be correct. So what we're going to do in October, first of all, is we're going to recognize that we have an additional sales return and allowance of $200,000, because we didn't anticipate that. We will go ahead and write off our allowance for sales returns and allowances, so that there's the combined $2 million, and reduce our accounts receivable accordingly. We're not going to receive that amount. We're not entitled to receive that amount, so we'll make that go away. In addition, again, you could make that debit to the sales revenue account directly, rather than sales returns and allowances. In addition, we'll go ahead and recognize that we've received our $13 million payment for our accounts receivable, increase our cash, decrease our accounts receivable, and call it done. All right. So this is just an example of some of the issues that you can come up with, that you can face with a sale with a heavy return. Can't talk anymore. With a heavy right of return. That you have choices to make about how much revenue you're going to recognize and when. I'm kind of a fan of this particular option, because it does allow you to go ahead and recognize your revenue, but it also puts anyone who might be reading your financial statements on notice that you don't expect to receive all of that. And it reduces your, instead of having the gross amount, when you look at the income statement for this company, you would see, assuming before October, you would see sales minus sales returns and allowances. And that gives you a good feel for what the company's actually able to do. All right, that's all I wanted to say to you about sales with a right of return. Take a look at the notes to the chapter as well as in the book, and let me know if you have any questions.